Ladies and gentlemen, good day and welcome to the Vijaya Diagnostic Center Limited Q4 FY25 conference call hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Amey Chalke. Thank you. And over to you, sir.
Hi, thank you. Good evening, everyone. I am Amey Chalke on behalf of JM Financial. Welcome you all on the 4Q FY25 earnings conference call of Vijaya Diagnostic. At the outset, I thank the management of Vijaya for giving us the opportunity to host the call. I'm looking forward to have insightful interaction on the quarterly earnings and the outlook here on this. Today from the company, we have with us Ms. Suprita Reddy, Managing Director and CEO, Mr. Sivarama Raju, Vice President Operations, and Mr. Dhiren Gala, Assistant General Manager, Strategy and Investor Relations. I now hand over call to the management for their opening remarks. Over to you, ma'am.
Thank you, Amey, for hosting the call. Good evening, everyone, and thank you for joining us today. I will begin my address with the updates on our expansion plans. I'm happy to announce the successful launch of 6 hubs in the last 2 months, 2 each in Pune, Bengaluru, and West Bengal. Additionally, the execution of 3 more hubs in West Bengal is progressing as planned and expected to commence operations within the next 3 to 4 months. We have also finalized leases for 2 hubs in Tier 2 locations of AP and Telangana, which are scheduled to become operational in H2 FY26. With the recent launch of 2 very large state-of-the-art hub centers and 2 spokes in Pune, combined with our investment in cutting-edge technology, we are confident that this will enhance the visibility of the Vijaya PH brand in the Pune market. We are now well positioned to establish a distinct identity and gain strong traction in this region going forward. We have ventured into Bengaluru market with the launch of operations at both our hub centers in April. Given the strong potential of the market, we're actively looking at a few more strategic locations for our hub expansion to strengthen our presence in this region. In continuation to our updates on the leadership team, we have recently onboarded a CTO who comes with 25 plus years of experience in leading technology-driven companies, and his addition strengthens our capabilities and is likely to help fast-track our IT initiatives. In addition, we have also made a few more mid to senior level hires across business functions to support our parallel expansion into new geographies. Now, I quickly take you through the financial performance for the current quarter of the 12 months ended 31st of March 2025. The consolidated revenue for the current quarter stood at a INR of 173 crores, reflecting a growth of 12% at a consolidated level and a 13% growth being driven organically, once again majorly driven only by test volumes. EBITDA for the current quarter stood at 69 crores as compared to 63 crores in the corresponding quarter in the previous year. The EBITDA margin stood healthy at 39.8% in the current quarter. The profit after tax for the current quarter stood at 35 crores with a margin of 20%. Coming to the full year performance, the consolidated revenue stood at 681 crores, reflecting an impressive year-on-year growth rate of 24%, with a 19% growth being organic contribution. EBITDA stood at 273 crores, registering a year-on-year growth of 24%. EBITDA margin stood healthy at 40.1%, and PAT was 143 crores with a margin of 21%. After a strong performance in FY25, we had a promising start to the new financial year with a notable increase in both the footfall and revenues across the network. Moving forward, our key areas of focus would be stabilization of the newly launched hubs and building strong brand equity in these new geographies commissioning additional new hubs in West Bengal and core geographies, investments in technology, and strengthening our talent pool across critical departments. With that, I would like to conclude my address and request the moderator to open the line for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star then one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star then one. Our first question comes from the line of Anshul Agarwal from MK. Please go ahead.
Hi, thank you for the opportunity. I hope I'm audible.
Yeah, you're audible.
Great. So I have a few questions. First question, is there any particular reason why our gross margins have contracted despite strong growth in wellness in the current quarter?
Actually, it is because of wellness, because I think wellness has contributed 15% of our revenue, and generally whenever wellness grows, you'll see some contraction in gross margin, right? Because this wellness is at a discounted price. So that's one of the primary reasons. And yes, to a certain extent, not a significant value. Some value has increased because of the increase in the input cost.
Okay. What I wanted to check was, is this on the back of any rupee depreciation which could reverse in the coming quarters, or should we structurally consider this to be the new normal in gross margins?
So you should structure it to be a new normal, right? And it is majorly because of wellness. And since there is an increase in the input cost, like we were discussing the last 2-3 quarters, right? So we have expected there will be increase in the, not just for the rupee depreciation, for multiple other reasons that's happening in international trade. Right, so that is the reason there is an increase. But with wellness, generally Q4, we see the higher contribution coming from wellness. But again, if wellness comes to 14%, then the gross margin will improve a little bit.
Got it. My second question is on the hubs that we had commissioned in November at Nizamabad. So have we broken even in Nizamabad and Ongole?
Ongole, yes, it's broken even. In fact, 2 months back, more from the last 3 months, revenue is crossing the break-even number. Right. In terms of Nizamabad, we launched a soft launch that happened in November. Actual launch of MRI happened in December.
Sorry, is it just me or I can't? The voice is echoing at Siva's end.
So Nizamabad was launched formally in December, Anshul, and what has happened also is Nizamabad was only functioning with high-end imaging and blood work for almost 2 to 3 months because it was awaiting the PCP and DT license. It is still not come in fact, and we still anticipate that as promised, it will break even in the first year from whenever we started operations. And Ongole has broken even a couple of months back.
Yes. And Nizamabad also, Anshul, so it is almost closer to break even. So maybe in a quarter's time, that should break even.
Great. Do we have any targets, ma'am or Siva, for the new hubs that we have commissioned in Pune, Bangalore for break even?
So the Pune centers, we've opened 2 centers, that is Ambegaon and Kalyani Nagar. Ambegaon has become operational from April. Kalyani Nagar, even though it is ready and can start operations, we are waiting on starting ops because the team is under training and we're starting to build a team for Pune separately. So probably another week to 10 days, you will see Kalyani Nagar open for operations. Both of these centers, as mentioned earlier, will break even in a year of opening. Likewise for Bangalore and Kolkata.
So like we guided before, Anshul, all the centers outside of
Telangana and AP, we normally take a buffer of 2 months or 3 months. That's why 1 year is what we say. But even though the target is to get them up and running in the first few months itself.
Perfect. So the break-even targets are intact.
Yes.
Okay. A question on the Bangalore market. So what will be our go-to-market strategy here? Because, this seems like a more corporate hospital-friendly market versus probably Pune. And any comments on pricing out here? Will it be similar to what we charge in Kolkata or Hyderabad? How should we look at it?
Anshul, if you ask me, this market probably is not at all like Pune. Pune is more the corporate kind of market, and Bengaluru has a lot of standalone integrated centers. You look at the largest lab player has been Anand for ages now. So they are independent players, region-wise, also keeping the traffic, the congestion, and all of that in mind. So these two centers that we've chosen, in fact, are two different corners of Bangalore. It's also to test out whether our go-to-market strategy in Hyderabad works likewise in Bangalore. And I should definitely say that it's looking very positive. Both are running, both are operational. We're very confident on a one-year break-even here. And the pricing is more like Hyderabad and definitely not like Pune or West Bengal.
Great. Thanks for your comments. One more question, ma'am. While, with the bunching up of these new hubs, can we expect a steep dip in margins in FY26 with a possible recovery in 27?
So like we said before, Anshul, so first 2 to 3 quarters till the time these centers break even, and like we also said, there are 3 more hubs that are going to come in Kolkata in 4 to 5 months' time, and then 2 in Andhra and Telangana. We should see some dip to the extent of 1 to 2% on the EBITDA front. But as we move forward, these centers will start contributing to the revenue, and then the next set of centers will come. I think by end of FY26, we should be back to our regular margins.
But just one more, if I can squeeze in, given the nature of lease accounting and due to these hub additions, do we expect depreciation and amortization expenses to outpace the growth by which our network is expanding in the next 2 years?
Yes. For the first 2 to 3 quarters, at least you'll have that. And I think once the centers break even, I think we'll be more or less sorted. But for first 2 to 3 quarters, you'll have that.
Great, very useful. I have other questions. I'll fall back in queue. Thank you so much.
Thank you. Our next question comes from the line of Alekia from Athena Investments. Please go ahead.
Hello. Am I audible?
Yes.
Yeah. Thanks for the opportunity. So my question is, as we see hub additions, so what's your capex plans in FY26?
Yeah. So as we just said, so we have already opened 5 centers. Even though there are 6 centers, one center technically fell at the fag end of March, so which was accounted in the last financial year. But considering the other 5 that we will open now and then 5 more which we are going to open, so you should roughly see a number closer to say 145 to 150 crore kind of a capex for this financial year.
Okay. So do we have any plans in entering into dialysis kind of businesses?
No, as of now, no. We are purely into only diagnostics.
Okay. Thanks. Yeah.
Thank you. Next question comes from Chirag from Keynote Capitals. Please go ahead.
Yeah, thank you for the opportunity. I would like to know what is the mix of revenue for FY25 in pathology. Could you just differentiate between routine and specialty tests?
So first coming to radiology and pathology, it is more or less in the same, like across the quarters we are seeing pathology anything between 62 to 65 and radiology from 35 to 38. So at a year level, more or less it was in the same mix. Coming to routine and specialized, like we always say, the definition differs across, player to player, right? But considering our own definition of specialized and routine, within radiology, 35%, so 20% is from advanced radiology and 15% is from the basic radiology. But again, within basic radiology, you have few advanced tests, but going by our definition, I'm telling you these numbers. Right. Coming to pathology, out of the 65%, close to 15-20% is specialized and the rest is routine. But again, this definition differs from player to player.
It would be great if you can just explain your definition once.
So basically, anything that comes, in volume that we do on a daily basis, like your fasting, thyroid, lipids, hormones, everything.
PSA, all of that comes under basic for us.
Basic for us.
And anything above, upwards of an AMH or a fertility panel, histopathology, all of that gets categorized as special.
Because few players even consider thyroid hormones as specialized, but we consider them to be basic.
Fair enough. My second question is related to understanding that are we still on the trajectory to think that we would be growing at 15-16% CAGR growth for the next 3 years?
Yes, absolutely yes.
And this is mix of volume and a percent of 1% or 2% value growth, correct?
Yeah, 1 to 2% of value growth and the rest is volume. Yes.
Fair enough. And could you just give some comment or highlight how things are panning out in the industry at this moment? What kind of growth the industry has, and because of CapEx, are we outpacing the growth? Could you just highlight that point?
So coming to the growth of the industry, again, different research reports give different numbers. So the number that we keep hearing, which we are not very sure, is about 11 to 12% is something that we hear from multiple research firms, right? Definitely, if you see the last 1 year of growth for Vijaya, it is not just the new centers of the capacity addition. Even the older ones, we have seen double-digit growth from the, even the older lot. Right. I think coming to Vijaya, the best strategy, even if you take for Hyderabad or the outside Hyderabad, right? One thing is the centers that we are launching are breaking even ahead of our timeline, of our targeted timeline, and also the existing centers within Hyderabad. While every year we think that Hyderabad gets mature, but within Hyderabad, we are inching market share year on year. If you take player number 2, 3, 4 of Hyderabad, they are not growing at the pace, in spite of we not adding any capacity in last 2 years in Hyderabad. They are growing at a much faster pace than them. I think it's the capacity that we have built, the quality that we are delivering, the name we have built, right? So these are helping us to grow at a faster pace. And also because you have the entire gamut of diagnostic services.
Right. Just one more question from understanding perspective of industry. Apart from brand and accredited labs, what are the ways for a company like Vijaya to make sure that they keep on gaining market share into a newer region? Is it just to do with the technology, or is it something else too? And secondly, being a leader in Hyderabad, I just wanted to understand what is the way for us to keep defending the kind of market share we have from the players who have been in the market. Plus, some of the pan-India players are focusing to get into southern markets now as they are trying to tap the new market. So just wanted to know how can we make sure to defend our market shares too?
So basically, if you see, right, so, there are 3, 4 important basically parameters for our business, right? One, we have to make the customer who is paying us happy. It's basically they're coming for a diagnostic service with trust, but at the same time, the way you maintain your, your centers. One, you're giving them very good infra, right? Then the technology. Then the the kind of doctor talent you have, because all this will help us in churning out a quality report. So ultimately, and when this report goes to a clinician, even a clinician has to trust the report, right? So when you are basically taking care of everything and then pricing it same like the market, I think that is something which we were doing for years, and that allowing us to gain that market share year on year. Right, and it is basically you have everything under one roof. That is basically the differentiator for Vijaya. So that's one of the reasons when we are venturing into geographies, newer geographies. Like if you take the example of Tirupati, even though it is part of Andhra, Telangana, it is much closer to Chennai. And by the time we went into Tirupati, there were already about 7 to 10 MRI machines, right? What made us stand out? Because you are giving quality. To give quality, you need equipment and doctors, good doctor talent pool and technicians. Right, the kind of infra you are providing, nobody else in the market is providing that. And on top of that, you are not charging anything extra. You're just matching the market. Right, this is allowing us to basically gain that name, and you have everything. You have few players in radiology, few in pathology, but we are delivering both. So it's a convenience for the patient. So I think since you're able to take care of all these things, that is allowing us to grow at a much faster pace.
Fair enough. Thank you. I'll join back the queue.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to register for a question, please press star then one. Our next question comes from Sumit Gupta from Centrum. Please go ahead.
Hi, am I audible?
Yeah, you're audible.
Hi, good evening, and thank you for the opportunity. So what volume growth can we expect from the addition of the new hubs, like incremental volume growth?
So, Sumit, whenever we add hubs, so initially, the trend that we have seen in the past is that we start off very well with advanced radiology and slowly the other volumes get built, right? So basically, what we expect is that the growth that in this current financial year, again, some 3 to 4% of the growth from the new centers, because we've just launched these centers, and the rest existing centers will give us the rest of the growth. So you should, but since again these are dominated, this will be dominated because of the advanced radiology. If these centers grow, gives us a 4% contribution to the overall growth, you may expect the volume to be somewhere around 2 to 3% in the current financial year. Because they may do good number, but the volume initially will be lower. It is because of the advanced radiology they pick up, and then slowly the other volume gets built.
Okay. And so regarding the EBITDA on the standalone basis, and like it is nearly flat on a sequential basis and just 7% growth on a YOY basis. So like majority of the growth is coming from the PH side. So just want to understand on that. And what were the margins this quarter for PH?
The margins for PH during this quarter were close to 29%. Okay. And, if you look at this quarter, and including last quarter, we had stated that there is a GST regulation, right? So because of that, the impact has been close to 0.3%.
So basically, Sumit, this quarter, even for PH, if you look, the number will look slightly off because there is one-off expenditure which we charge to the P&L. Otherwise, the margins were closer to 35%. And this was because, Pune, the expenditure has started for these new centers, right? So we have taken people, training, all that is hitting the P&L, but the revenue has not actually started. So if you exclude that one-off expenditure and if you see the EBITDA for Q4, it was close to 35. In the earlier quarters, it was about 39 to 40, but because of the incremental cost on hiring of new talent for these new upcoming centers, you have seen that because the balance sheet size itself is very less, it generates only about 11-12 crores. Now all of a sudden we've added 2 hubs and 2 spokes, right? So I think we should give 2-3 quarters time to see the actual EBITDA for Pune. And coming to the general at a company level EBITDA, Sumit, I think because we have also added resources at corporate level, right? We have taken multiple digital IT initiatives, right, where we have moved servers to physical to cloud, and some significant investments we have done on digital marketing, which was not the case earlier, right? In spite of incurring all this expenditure, the EBITDA is intact because of the leverage that we are getting from the existing network.
Right. So going forward for PH in particular, the margins will decline. Or like how should we see the trajectory of PH?
Yeah, so optically it will look slightly off, Sumit, because as on date is city center. You see 95% revenue coming from city center.
I'm sorry, sir, you're not audible. The voice is being offered, so.
Is it clear now?
No,
sir. Even right now, there is a magnetic disturbance which comes.
Is it okay now?
This is better,
yes.
Sir, yes.
Right. So what I was saying, Sumit, so basically if you see Pune, right, 95% of the revenue comes from 6 centers, 3 hubs and 3 spokes, right, and all of a sudden we've added 2 hubs and 2 spokes. That means we have increased the capacity almost close by 70-75%, right? So obviously initial days the cost will kick in, but the revenue will take some time, right? Optically, if you see PH as a standalone center, PH as a standalone company for next 2-3 quarters, optically the EBITDA will look low. But otherwise, I think we have to wait for that 1 year where these centers will start breaking even.
Centers stabilize and also
right?
the hubs stabilize, and then you're probably going to see normalization happen then.
Yes.
So by FY27, we can see stabilization and improvement in margins as well as return.
Yes. But if you see Vijaya company as a whole, it will not impact much. Like we said, for this year, in the first 2 to 3 quarters, you may have that hit of 1 to 2% on account of all the 6 hubs starting at a time.
Understood. Thank you.
Thank you. Your next question comes from the line of Gaurav T. from Antique. Please go ahead.
Hi, good evening. Any reason for the, lower year-on-year growth for the quarter on the revenues? We've been growing, upwards of 20%, excluding PH, be it test volumes or, overall revenues. This quarter, growth has slowed down a bit. So any insights into that?
Yes. So if you see at, like you rightly said, at a year level, I think excluding BH, organically we've grown by close to 18%. Right? And yes, Q4 was slightly soft. In fact, within Q4, if you basically break up in 3 months, February 1 month which has pulled down the entire average. So February 1 particular month where we have grown only a single digit, which has pulled down the entire quarter's average.
Sorry, sir. Again, it's not very, clear. I'm not following you clearly.
Is it clear now?
No, sir. Again, there is the same magnetic disturbance which is coming.
Can you hear me now?
No, ma'am. It is still there.
What about now?
So this is slightly better.
Slightly better, right?
Yes.
So basically, in Q4, February 1 month, which was softer, right, which has pulled down the entire quarter average. So we have grown only by generally Q2 and Q4 for healthcare are the better quarters. Right, and generally what we have seen in the past is that Feb, in spite of being only 28-29 days, doing a better revenue than Jan. That was the trend in the past. But for different reasons, the season was slightly off. Sometimes healthcare is all about seasonality, and that happened only in the month of Feb. So while we try to see reasons for that, but we don't have any concrete reason general season was low, and it was also attributed to both the festivals and the other events that happened across India. But otherwise, if you see again from April, right, post Q4, the numbers are intact.
There's an incremental increase in both footfall, revenue across all of the centers in Hyderabad and rest of Telangana. So Feb was a month which was also odd to us, but like Shiva has mentioned, it was purely seasonal and a lot of factors affecting it. It was also a time when there was a lot of travel, the Kumbh Mela, and lots of things happening. So I did not see numbers coming in through the month.
Sure. Thank you. If we look at, overall FY25 revenue growth, regional split, and outside of, Hyderabad and, Andhra Pradesh, Telangana, the non-core markets excluding PH, we're seeing revenue growth of only 5%, for FY25, which, kind of is low given our penetration and, all the other initiatives we're taking. Were there any one-offs in this as well, probably Kolkata and Fokyu or some other reasons?
Gaurav, in fact, so if you see, other than PH, right, even other than Hyderabad, if you take rest of AP, Telangana, and even that for that matter, Kolkata, right, if you club all that together, excluding PH and excluding Hyderabad, it is upwards of 20%, the growth rate.
The contribution is 5%.
Contribution is 5%, yes.
But the growth is upwards of 25% almost.
Okay. Maybe that's comforting.
Yeah.
Thank you. We're adding largely hubs this year. We expect, they would break even in 3 to 4 quarters. Any insights, what can be the planned expansion for FY27? Significantly higher number of spokes and, significantly lower number of hubs there?
It also depends on the geography, because if you look at Bangalore, you've opened 2 hubs in 2 extreme corners of the city, and until Bangalore gets a minimum of 7 to 8 hubs, you cannot connect them with spokes. So Bangalore would probably take longer to open up spokes compared to East India. Kolkata will definitely see a lot more spokes come up in 27 because we've already opened 3 now, VIP plus 2 more, and you're opening another 3 coming up. So another 2 hubs will give Calcutta a chance to open up spokes in 27. Pune, of course, you will see a lot of spokes coming up from now on. After stabilization of these 2 new hubs that have opened, that's when we will start opening the spokes in Pune. And in rest of AP, probably you will see more of hubs coming in because after separation, there are about 3 or 4 more places, markets that we've not gone into. So those are the 4 key primary markets that are of interest where we will go in and open those hubs, and that is when probably if we see traction at most there.
Sure. No, thank you for that. Coming to gross margins, are you sharing the split for gross margins for radiology and pathology for Q4?
No, basically we show it as a single number, Gaurav, but generally what we see in radiology is like closer to 10%, right? So 90% is the gross margin.
91% is the gross margin for the radiology segment, and generally for pathology it is anywhere between 86% to 87, 85 to 86%.
It doesn't change much actually.
Got it. Last, if I may, just last question on the balance sheet. On the other current financial assets and other current financial liabilities, I'm seeing quite a large increase, year on year. What would be the nature of this?
So basically capital creditors. So if you see, we have opened say three hubs in the last financial year, and also in fact we have added few of the advanced radiology equipment in our existing centers like Gurgaon, and we have added one more MRI in Kurnool. Right? We have added a cardiac CT in Tirupati. So basically with our vendor, we have a deferred payment option as part of our negotiation. Right, where we'll be due for that payment in the next 2 to 3 quarters. So that's the reason you see capital creditors of I think close to 75 crores. Yeah, that's the reason. So that is so if you see the net cash, right, on the balance sheet, you look the cash is about close to 280 crores. But if you remove this capital creditors and if you see the net cash, it's close to 200 plus crores.
Got it.
It's purely as part of negotiation. That's all.
No, that's helpful. No, thank you. All the best.
Thank you. Our next question comes from Rishi Modi from Marcellus Investment Managers. Please go ahead.
Yeah, hi. Am I audible?
Yes, Rishi.
Yeah, hi. I might have missed this, but what is the exceptional expense that you have recorded in this quarter?
It's basically on account of this merger of Medinova with Vijaya.
Okay. All right. Apart from that, on the Hyderabad front, right? So I see we have 10% growth, and our wellness business has come to a 20% growth YOY. Just wanted to understand, is there like I think you said some Kumbh Mela thing, but apart from that, anything else that flows into that number?
So in terms of wellness, Rishi, there are 2 reasons here. One, if you take Pune as a geography, right, slightly wellness share is high in Pune. In the last year, it's not fully consolidated. It was only consolidated for 3 months. This year, we have consolidated for the full year. There is slight effect because of Pune, because in Pune, with the corporates all being present, the wellness portion is upwards of 15% that we do there. And other than that, naturally, with the kind of efforts that we are putting digitally, all that, the wellness share in the current financial year across the quarters have inched little bit for us in the core geographies. Not only just in Hyderabad, even in the tier 2 geographies of Andhra and Telangana.
No, so I meant that till Q3 we were growing healthily organically at 20% plus, 25% plus. That's come down to 20%, EMI in that insurance-led quarter. So that's why I'm just checking whether there's anything which is structural in that, or it's just something which we...
I think it's the same reason, Rishi. Overall, we have seen the season to be dull. It is across the modalities. And also, if you see March, right, so basically the entire festive season which was supposed to be bit of April has come into March, the entire season of Ramzan, and then you had Ugadi, everything within March. So we are guessing that because of these reasons, the season was slightly dull.
Okay. All right. And on the Pune piece, right, Q4 versus Q4 last year, given the split of revenue that you all have provided, my numbers come out to be a decline on a YOY basis. Now, some decimal here and there, it might be different, but it's not grown is the point. So just wanted to understand what, like, is it something which is intentional, and if it is, what's happened there?
So it was again conscious decision. So basically, if you see at the overall year, I think we are at the same with a marginal growth, right? But in Q4, like you rightly said, there is a dip in the revenue of I think close to 5%, right? Majority of which I would say almost of it is was because of B2B. We have to consciously close a few B2B tie-ups because those were not.
We were actually doing a lot of aggregator business, Rishi, and we also gave it some time to understand that market and what kind of business is actually coming in. And when we're actually only making sure that tests are coming in, payments were becoming an issue, it was a conscious decision to hold off some clients, wait and see, and that's, I think, the minimal dip that you're seeing, but that's a conscious decision that we've taken.
Okay, so now if we are reducing the B2B spend, should we assume that margins in Pune can go beyond that 39% levels that it has been?
Also, you've also heard me saying that Pune, the organic 6 centers that we acquired, have capacity issues. So there are two reasons for this. One is a conscious decision of an aggregator business coming in at a lower cost and not getting paid. I'm creating capacity probably for a B2C client to come in. That is one bit we'll have to wait and watch this quarter. And the second one is definitely try to increase the direct walk-in and create some capacity in these geographies since we're not adding new centers in these places where they already exist. Both of these centers that we've put are in areas where there's no presence of PH earlier.
Okay, all right, great. Yeah, that's it from my end. Thank you.
Thank you.
Thank you. Our next question comes from Chirag from Keynote Capitals. Please go ahead.
Yeah, thank you for the follow-up. I wanted to know what are the breakup for the number of centers, 151 centers that we have. Could you divide it in the number of geographies?
So basically, across so in
Pune have about 16. No, not 16. Now 18, it's become 18.
18 centers in Pune. Then you have 2 in Kolkata, according to as on 31st March, right? So you have about
127 centers in AP and Telangana combined,
and then 1 in Karnataka and 1 in Gurgaon. This is as on
31st March. Yeah. Okay.
So earlier we used to give it Hyderabad and rest of AP and Telangana. Could you just divide that?
Hyderabad is closer to 95 centers, so the rest are from other than AP and Telangana.
Got it. My second question is, what are our thoughts related to branding spend for the coming years? Is it like an absolute number in your mind, any ballpark, or would it be variable with the revenue that we are doing?
It depends on the geography also, because if we are looking at geographies where we are opening centers in Calcutta, I don't think digital works in places like Krishnanagar and Barasat, which are typically outskirts of Calcutta. Whereas Pune, you will see a lot of digital spend happening. It depends on the geography, the clientele, the age group. Even in Hyderabad, amongst these 95 centers, there are different ways of marketing that we try to do. There are certain areas where we only market wellness. There are certain areas where we do a lot of diabetic camps. So it depends on the geography. Probably cannot put an exact number to it, but depends on where we're going.
Fair enough. And last one from my side, could you let me know what is the size of our phlebotomist team and how much revenue how much collection in pathology do we do from home collection?
So in home collection, we 2.6% is the revenue that we get from the home collection at the overall revenue, which will be almost close to 4% of our pathology revenue. Coming to phlebotomists, we have
So the two teams, if you're asking, the home collection team is completely different from our in-house phlebotomy team. In-house phlebotomy team
600 plus.
Is almost, more than 600. We wouldn't know the exact number. And home collection team would be around
35 to 40 people. So, yes.
Fair enough. Thank you. Thank you.
Thank you.
Yeah.
Our next question comes from the line of Harshal Patil from Mirae Asset Capital Markets. Please go ahead.
Good evening, sir, and thank you for the opportunity. So just have two questions more from an understanding perspective. So we've been mentioning about commissioning quite a lot of hubs recently in the past 2 months and a few lined up over the next 2 to 3 months. So, sir, my question was basically at what point in time after setting up the hubs would you probably take up or start thinking about setting up the spokes in those respective areas?
So again, like ma'am just said, so it depends on the geography, right? So in Kolkata, we already have 2 hubs present, and then we just launched 2 more, and we're going to launch another 3. It all depends on the geography. So now Kolkata from next year will give us a chance to put spokes because already 2 centers got stabilized. Whereas for a geography like Bangalore, we just ventured into that market. We launched 2 hubs in 2 different corners of the city. We'll have to add a few more. You'll see spokes only after 2 years. Yeah. And in coming to Pune, because already it's an acquired network, right? Because they have the mix of hubs. We have launched recently 2 hubs and 2 spokes parallelly, right? It all, it depends on the geography, right, and our presence in that geography.
Sure. Got that, sir. So just second thing would be with respect to our growth thing. So we've been alluding to 1 to 2% of a growth going ahead, probably driven by pricing action or volumes. I believe that would be more based on an assumption of a favorable case mix that would drive the growth. So that's one thing, but if I have to kind of, just analyze about the revenue per test over the past 2 years has been almost like kind of a flattish thing that we are reporting. So is there a contemplation of any pricing action apart from the inflation or the case mix that would be driving the overall revenue per test or something like that?
So basically, like you rightly said, it's a function of, the earlier, at least in the last 2 days, it was a function of more of case mix and very little bit of pricing. But the only reason why you are seeing the average realization per test to be flat was because the capacity that we have added in the last 2 to 3 years was more in tier 2 locations, where the pricing is slightly lower than what we see in Hyderabad. Right, but going forward, you are seeing the capacity building in cities like Pune, Bangalore, and Calcutta, where the pricing is more or less in line with Hyderabad, slightly 5% here and there when compared to Hyderabad. Right, and coming to the price increment, yes, definitely, this year we will take a price increment, but again, only price if you see, it will not be more than 1-2% of the total revenue. But since, like we also mentioned, the input cost of few of the consumables have increased, that's the reason we have seen a dip. Slight dip in product margin. We will take pricing increase on few tests, but at the
Sorry to interrupt, sir. There is a magnetic disturbance coming from the line again.
How about now?
It's still there.
Still. Clear now?
No, sir. It is still there. Sir, the disturbance is still there. What I'll do is I can disconnect and I can reconnect your line. Just give me a minute.
Yeah.
No problem. Ladies and gentlemen, please stay connected while we reconnect the management.